Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for October 1st, 2016. Markets in bullish normal conditions on an annual basis with weekly RSI 14. We are at the higher end of neutral, 61 out of 100. 10-day basis, higher end of neutral also with a 73 out of 100 score. In the market mosaic, price with respect to the 200-day moving average is white bullish at 5.80% above. Slope of the 50 is almost flat at 0.02%, so it's yellow neutral. ADX is a non-trending 16.8 with a basically toss-up between bulls and bears. No trending. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is 1.036. So we have just nudged into risk on. Take the score, compare it to the last 5,000 trading days, find the average and standard deviation, lets us compute the risk Z, which is at 0.32. Here you can see a 90-day histogram of that indicator. We've gone from -2 to +3 to -2, back just into the green here. This has been a time when traditionally swing trades have started to work on the long side as volatility declines. Because of the special conditions of the election coming up, I'm playing this very carefully, maybe half size and half the number of signals I might normally take. I want to see intraday trades earn their money and then carry that over into swing trades, rather than just going with the normal complement of swings. These will be the current holdings of blended monthly rebalancing on Monday. So it's still a carryover of small caps, emerging markets, and tech as the strength in the indices. You see Brazil, the BRIC countries, and China in the extended ETF 32. ETF 2 is at 100% exposed in the theoretical model and in the model portfolio. Almost everything is above its 4-month moving average in the 13 ETF portfolio and 32. You can see the leaders here based on that 3 and 6 month blend. In ETF Max, we're looking at over 1,000 ETFs. These are the ones that run to the top. The ones that are green across the board would be ones that we're interested in as a continuation of momentum. The ones that are greens and then red pullbacks are ones that we would be stalking for rebounds or a continued weakness as they might go back to the mean. Same thing with the S&P 500. We're looking here at the ones that are in the green and green all the way through. So I'd be looking for more follow through in NVIDIA, Consol Energy, and Devon Energy especially, and I'd be looking in Chesapeake Energy as a potential rebound play. Although it has been suffering for over a month, maybe this is one that its run is done. So I'll be looking at Chesapeake, Vice, Devon Energy in the energy sector for sure. And then down here looking at Kinder Morgan, Pioneer Natural Resources, Amazon, Anadarko. This is the market health check. The slope of the dragon is up. The 10 is up. The 30 has rolled over and started to slope back up. It's still underneath that dotted line, the 0 line, so it's still negative, but it has been improving here carefully. But we really got to see a close above 218 to be convinced that this 60-day sideways chop here is over. Really, there's only been one test and then a 10 or 15-day recovery from that sharp sell-off. But as we get closer to election day, I expect there to be more volatility, so I'm going to be anticipating large range days, but little to no follow-through until we get some resolution in politics. ETF to regional report, everything's on a buy signal, so we're at 100%. This should read 100%, 100%. S&P at 48 is still below the globals at 51. Inside the U.S., it's small caps and tech, followed by mids, and then the S&P. Two strongest sectors, Japan and U.S. technology. Two weakest, the S&P and then the European 350. In the world market model, you see a real divergence here in Asia. You got great news stories and horrible stories. Europe has started to mellow out and blend around the mean. Latin America has come back into the white, while Brazil remains in the green, so maybe losing some steam here in Latin America. Small caps are solid. Mostly the growth is solid, but otherwise U.S. is below average in the yellow. ETF Top 30 reflects a lot of the same strength that we saw on the BMR view of the world, but adding green and white here in the form of the regional banking. Otherwise, it's biotech, technology, Brazil, some energy, metals and mining, still strong. In the Dow, Caterpillar, Intel, Apple, Cisco, and then a significant red population down here. So you get quite a bit of divergence in the Dow, even among the U.S. large caps here. Nike, Coke, General Electric on the bottom for value plays, perhaps. Next up, the daily report, going into Monday. A handful of channelings and some auto framers. No signals here in the channeling and overreaction. But yes, on the wider set of Dow symbols. A handful of auto framers, plenty of dojis from Friday. Not many patterns to choose from. 551W in McDonald's. Same story in the ETFs, just a handful of dojis. Only a couple auto framers. This is really a market in the middle of its choppy trading range, and looking for volatility plays. The usual suspects in the regression line fractal framework. The deep value plays are McDonald's, Coke, Johnson & Johnson, GE, and Verizon. So McDonald's is interesting because we saw over here it was a 551W, and so that means that Friday was an update. And if we want second day momentum follow through, maybe McDonald's is in a posture. So we're looking at McDonald's on a daily chart here. You can see that significant move downward, RL70 downward, but it's held really 1, 2, 3, 4 times here at 115. Had just an inkling of an improvement on Friday. Room for this to go if you say low risk move with about $1 stop, if it makes a new high on Monday with a stop below here and ready to stop and reverse. There's some possibilities at Z2, Z3, and then if it clears this hump at 119, off we go back to the midpoint here, around 120. So as a deep value play, there's some possibilities here in McDonald's, and really it's on the basis of failure to fail, and it has tested that Z2 support level 3 times and didn't break, and they were willing to hold it overnight, so that's of interest to me. Now you can see Coca-Cola is in the same condition here, not as much support in terms of 3 sets of tests, but it's been almost 10 days, and it was a higher low, closed higher. So there's some possibilities here, past aiming at 43 and a half, and then 44, and all the way back to 45 and a quarter. Would really have to get above 44 to be a rejection of this downward pressure. But if it gets above 44, you can see there's a lot of volume here that will release energy going north. All right, let's take a look at Johnson & Johnson now. So now we have Johnson & Johnson kind of in the same position. Notice about 15 days of failure to fail further. maybe even one little final test Thursday, and then Friday was a healing day, and he held it overnight. This is typical of symbols in this position, so if this appeals to you, what we end up getting is strong relative strength move, and then an owl short position on a daily, because you have an RLCO outside the river. RL10 crosses the dragon. The 30 has rolled over at a peak right here. The dragon sloping downward, the 30 sloping downward. This is the pocket entry here in the owl for a very nice short from 124.5 all the way down to 118. Failure to fail further here. It got out as far as Z3 and Z2, and now that's become normalized. And so now if it fails here on the upside, I would say where everything crossed the RL270 is kind of the objective fair value, 121.5. But my target would be 124. So if it doesn't collapse here, then the natural spots would be 121, then 124. You're buying it near the low of the support level here. So you've got most of the favorable gain ahead of you. But if it collapses, you're not paying that much for the stop and reverse, which would then, you would say, the size of the move from 118 to 124. That's the size of the move from 118 down to about 112. That would be the easier play, because if this shelf collapses, then that's a runaway move to the downside. So that's what the deep value plays look like. We'll take a look at regression line fractals from the other side now. And what we'll look at are Apple, Intel, and Caterpillar. All right, this is Apple. This is that leading candidate for the numbers of ATR above its RL270. All these lines just means that I've been framing a lot of trades in here on this move from 94 to 115. But what we have now is this a sign of stalling? Here was one long stall. It had one more surge in it, but the size of this surge was half of this surge and this surge. So maybe that's 1, 2, and 3 legs up. And so if we get a collapse here, then the target is back to the Bollinger Band mean, then Z minus 1, Z2, and Z3. But if it's able to hold support here at 111, then I would expect a move of about maybe 10 points. This could go to 120, 122 to the top of the stack here up to Z3 if this sideways shelf holds. So that's Apple. My concern with this one personally is that I just always feel like the move is in, and I'm a latecomer to the party, and whereas for me it's easier to see the downside move. But this is one certainly when they're in these critical states, you can frame this in either direction, because we just had the RL10 cross the dragon, the baby dragon rolled over. The 30 has not yet rolled over, but it's at a position where any more weakness in it does start looking like an owl. So we're ahead of the owl right now in terms of the downside. That's what makes this one an interesting pattern. Intel in kind of the same condition, although what we have here is much more evidence that it's ready to break out. So this one really actually looks favorable. If it can get above 38, that thing's free and clear. This has been stronger than the market, which had that sell-off and then came back. This one already is pushing new highs. So Intel is actually pretty favorable, and that's contributing to the strength in tech. Again, this is one that I've been trading along the way. And Caterpillar, just earlier in its phase, this is the argument for the Z3 pinch breakout. Free and clear. It's well above this resistance level at 84, and I think you can buy a continuation intraday and then try to hold that one overnight. That's when I would be willing to do that. Failure here at Z3, though, means that the test is back here to 83. And let me say 84.5, where the top of the dragon hump would act as support, and if that breaks, then it's down to 83. Back to the daily report, you see how we're in the middle of this sideways chop. Increasing daily volatility makes the intraday trade attractive, but the price being right in the middle of this price channel makes it difficult to find good swing frames. And then my comments about the the silly season of politics kind of restraining these swing trades until we get some resolution. Then I expect to see price action on a swing basis once we see what sectors are likely to benefit from the win in the presidential politics. So just looking at some reference charts. Interesting here, emerging markets at 0.7 in terms of signal to noise ratio. That means the intraday trades have been very directional in emerging markets. Combine that with relative strength outperformance, and that's a good thing. And you see the same thing in metals and mining with XME here with a 0.53 in the green. Anything in the green is something that has been exceptionally strong in terms of intraday directionality, making it a good intraday candidate. These ones in the red then correspondingly are ones that where if you get an intraday move, it's better to take the bird in hand because there's been a lot of backing and filling inside the daily range. Locked inside the river in this sideways chop, 60 days of sideways chop. Everything coming back to the z-score of 0 right in the middle. That's the working definition of a choppy sideways market. That's everything I want to cover on the daily and weekend report. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.